To the extent that June was a bit of a wobbly month for investors with all sorts of worries about asset valuations, July was a lot better. Generally, equity markets did well, with the exception of India, which is still struggling, and bonds improved a little at the same time. So if you get a chance, all the details, tap into our website and have a look at our commentary, which give you all the facts for last month. And remember, we do that every month for you now, so you can always go and see exactly what happened in the previous month. Another thing that we do at the start of every month is to look very closely at market fundamentals. And you will have noticed that the markets have been quite wobbly. They've been nervous about QE. When Governor Carney was announcing his new forward guidance policy, markets were very wobbly. Pound went down and then recovered very quickly, and markets had a bad day, at least in the UK in particular, when those announcements came through. The reason for it is that equity valuations are more stretched than they were a year ago. Price earnings ratios, the amount you pay for every £1 of profit from your shares in the US, are now around about 18, 19, and a year ago they were about 13, 14. Price to book ratios, the value of a business sold on the stock market compared to the value of the business on its balance sheet, i.e. the value of its assets, is also stretched. US price to book ratios are over 2.5. These are not good for short-term improvements in equity prices, and what needs to happen now is that earnings improvements, better profits, need to come through in the corporate sector before shares get another lift up. That may come a little sooner than we think, because we think the US economy is going to go back into a big improvement in 2014. In the interim, it's going to be a little wobbly on markets.